Hello out there to you. In this video, we're going to think about a perfectly competitive product or a perfectly competitive industrial market. What that means is that the products are identical. Everybody's selling the same product, and it's relatively easy for new firms to enter or exit the market. That's what that means. So you can think about it. Most agricultural markets are perfectly competitive. So what that means is everybody's going to sell at the same price, so they're going to kind of give you a price. You've got to think about what the price would be. First question says, what's the market price if the firm's earning positive economic profit? So you're always earning positive economic profit if your price is higher than your average total cost. So if price is higher than average total cost, you're making a profit. So we want to just look for where does the minimum of average total cost go. So this would be this minimum right here. That's sometimes known as the break-even point. So the minimum of average total cost, or the point where marginal cost equals average total cost. That always happens at the minimum. That's going to be the break-even price. So any price above $8. So it says which labeled price. That's going to be 10 because I only have couple of labeled prices, but any $8 and a penny all the way up to $10 or further, that's going to work. Okay. Explain how the short run price could get in the long run. Well, it's going to decrease because a higher price than average total cost is going to attract new firms to enter this business. So new firms are going to want to show up, and that increases supply. Or to draw that would increase over here and decrease the market price and push it back down towards 8. Now, if it goes down any lower, then this firm's going to lose money. They'll exit the market. It decreases supply, pushes it back towards there. So $8 is our long run equilibrium, which is that break-even price. Okay. Which labeled price would they operate in the short run but leave the market in the long run? So this is asking about the shutdown rule. So a firm is going to produce as long as they can cover their variable costs and pay into their fixed costs. So you want to look for the minimum of average variable cost, which is right here. So any price between 4 and 8, the firm is going to operate in the short run because they're minimizing their losses, but they're going to exit in the long run because they don't want to lose money in the long run. You can prove this if you pick a price of say $6 and then calculate its total revenue, which would be 6 times 15, and then calculate its total cost, which would be maybe $8.50 times 15. Calculate that and then take that against the fixed costs, and fixed cost is always going to be lower than what you calculated there. So that's how we know it works. If the short run market price is $8, what will the firm's revenue be? So total revenue is just going to be price times quantity. So in this case, we're going to say that the price is $8. We're going to multiply that by 18. 8 times 18, I don't know. Let me see if you can see my calculator. You can. 8 times 18. 144. So 144 will be the total revenue. Okay, and we're done there. And then finally, if the government instituted a per unit tax, which is sometimes called an excise tax, which curve would move? That's going to be their marginal cost. It's going to move because they're going to have to pay that cost. Per unit is that cost. That would also shift average variable cost and average total cost, but they're really asking about the marginal cost.